In an investment landscape brimming with opportunities and risks, are Treasury bonds the safe haven they're touted to be? Marketed as the financial equivalent of a bomb shelter, these government-backed securities promise stability and security. However, beneath their serene surface, there lie submerged costs and complexities that every investor should be aware of. This essay will unravel the real costs embedded in the seemingly tranquil world of Treasury bonds, offering insights that could potentially reshape your investment strategy. Treasury bonds, or T-bonds, are long-term securities issued by the US Department of the Treasury. They come with a promise of fixed interest payments over their maturity period, which generally spans 20 to 30 years. Investors receive these payments semi-annually, and the principal amount is paid back at maturity. The backing by the US government gives them a reputation of being virtually risk-free concerning default. The safety of Treasury bonds is a major selling point. Investors often flock to them in times of economic uncertainty. This flight to safety is driven by the guarantee that comes with government backing, making them a popular choice among risk-averse individuals. The price of safety opportunity costs. Investing in Treasury bonds means accepting generally lower yields compared to more volatile assets like stocks or corporate bonds. This is the essence of opportunity cost, sacrificing higher potential returns for the sake of security. Especially in bullish markets, the cost of missing out can be significant. Despite their low-risk profile, Treasury bonds are not immune to interest rate changes. When rates rise, the value of existing bonds with lower rates falls, potentially leading to capital losses if sold before maturity. The longer the bond's maturity, the greater its sensitivity to rate shifts. Inflation can significantly erode the purchasing power of the fixed returns from Treasury bonds. If inflation rates surpass the bond's interest rate, what seemed like a safe bet could lead to a net loss in real terms. It's crucial for investors to consider this risk, particularly during periods of high inflation. While Treasury bonds are exempt from state and local taxes, they remain subject to federal income tax. This tax can substantially decrease the net income from these bonds, affecting the overall returns, particularly for those in higher tax brackets. Generally, Treasury bonds are highly liquid. However, this liquidity can vary significantly depending on the bond's maturity and market demand. Investors needing quick access to funds might face challenges, particularly with less commonly traded bonds. Comparing maturities, the choice of a bond's maturity should align with the investor's financial goals and timelines. Short-term bonds offer less yield but lower interest rate risk, whereas long-term bonds provide higher yields at the cost of greater risk. Let's consider the global perspective. Treasury bonds are influenced by global economic events which can affect everything from interest rates to inflation expectations. Understanding these dynamics is key for investors who need to anticipate market movements. Not all investors are suited for Treasury bonds. Those with a lower risk tolerance or nearing retirement might find them more appealing than younger investors or those seeking higher returns. To conclude, Treasury bonds carry hidden costs that can affect their attractiveness as investments. Understanding these costs is essential for making informed decisions. Always consider personal investment goals and consult with a financial advisor to ensure that Treasury bonds suit your portfolio. In the ever-evolving world of investments, Treasury bonds are often heralded as the epitome of safety, a fortress against financial storms. Yet this perceived sanctuary may carry concealed costs lurking beneath the surface of its stable facade. This essay delves deep into the true costs of investing in Treasury bonds, revealing insights that could redefine your investment horizon and decision-making process.